Navigating the financial markets for the first time can feel overwhelming, but mastering the fundamentals is your fastest path to building sustainable wealth. Trading isn't about getting rich overnight or gambling on random hype. It's a disciplined business centered around managing risk, executing clear strategies, and understanding market behavior. As a beginner in the US, your primary focus should be grasping how different asset classes operate, whether you choose to trade equities, ETFs, Forex, or options. Wall Street moves fast, and while price fluctuations create incredible profit opportunities, they also demand structure and patience. The most successful traders don't try to predict the future with 100% accuracy. Instead, they rely on proven probabilities, detailed chart analysis, and strict daily routines to stay ahead of the curve. Before placing your very first trade, you must establish a rock-solid foundation by opening an account with a secure, regulated U.S. brokerage like Fidelity, Charles Schwab, or Interactive Brokers. Once your platform is set up, learning how to analyze market charts becomes your daily map. Technical analysis allows you to read candlestick patterns, identify key support and resistance levels, and spot prevailing market trends before committing real money. Pair this visual data with fundamental analysis, such as tracking corporate earnings reports, Federal Reserve interest rate policy, and key economic indicators, to understand the macro environment driving price action. Balancing both technicals and fundamentals gives you a massive advantage over casual retail investors who trade purely on emotion or social media rumors. The ultimate key to longevity in day trading or swing trading comes down to strict risk management and unwavering psychological control. You should never risk more than 1% to 2% of your total account balance on any single position, ensuring that a string of normal market losses will never wipe you out. Incorporating automatic stop-loss orders on every entry protects your capital from sudden market drops, allowing you to cut losses quickly and let your winning trades run. By controlling your risk and keeping your emotions like greed and fear out of the equation, you transform trading from an unpredictable gamble into a professional, systematic routine. Once you understand the basic mechanics of market analysis and risk management, the next critical step is selecting a trading strategy that aligns with your personality, schedule, and capital. Day trading involves entering and exiting positions within the same market session, requiring complete focus during regular U.S. market hours from 9:30 a.m. to 4 p.m. Eastern Time. Swing trading, on the other hand, allows you to hold assets for days or weeks, making it ideal for those who want to capture larger momentum moves while balancing a full-time job. Beyond stocks and ETFs, many U.S. traders explore options trading to leverage smaller amounts of capital or hedge existing positions. Whichever route you choose, specialization is key. Focus on mastering one specific market or setup before attempting to trade multiple financial instruments simultaneously. To turn trading into a predictable system, rather than a series of random decisions, you must build and execute a written trading plan. Your plan should explicitly state your rules for entering a trade, setting profit targets, placing stop losses, and identifying market conditions where you should stay on the sidelines. Execution is where most beginner traders struggle, as impulse buying and chasing stock rallies often lead to severe drawdown. By maintaining a detailed trading journal, recording your entry price, reason for entry, emotion during execution, and final outcome, you can identify patterns in your behavior and continuously refine your edge. Treating trading with the seriousness of a high-performance business is what separates profitability from costly hobbyist mistakes. Beyond individual strategy, staying tuned to macroeconomic developments is essential for protecting your portfolio against sudden volatility. Major U.S. economic events, such as Consumer Price Index, CPI, releases, non-farm payroll reports, and FOMC meetings, can spark rapid price swings across all financial markets in a matter of seconds. Smart traders anticipate these events, adjusting position sizes or tightening stop losses ahead of major news announcements to minimize unexpected exposure. As you build consistency, remember that capital preservation always comes before capital appreciation. Protecting your account through disciplined sizing and disciplined risk control ensures that you remain solvent long enough to let compound growth work in your favor over time. A crucial pillar of long-term trading success is developing deep chart literacy through the lens of price action and technical indicators. While raw candlestick price movements show you the direct fight between buyers and sellers, technical indicators like moving averages, the relative strength index, RSI, and volume profile provide essential context. A moving average can help you identify the overall direction of a trend, while RSI signals whether an asset is overbought or oversold in the short term. However, the biggest mistake new traders make is cluttering their charts with too many conflicting indicators, leading to analysis paralysis. Keep your charts clean and focus on high-probability setups where multiple factors converge, such as a key support level aligning with a major moving average during high trading volume. Understanding market structure and liquidity is what allows professional traders to enter positions with precision. In the U.S. markets, liquidity fluctuates throughout the day, with the highest volume and volatility occurring during the market open in the morning and the closing bell in the afternoon. Recognizing how institutional investors, like hedge funds and mutual funds, move large blocks of shares gives you a massive edge over retail traders. Instead of trying to fight institutional momentum, your goal is to align your trades with the flow of smart money. Learning to identify liquidity pools, breakout confirmations, and false moves prevents you from getting trapped on the wrong side of a fast-moving stock or index. Finally, managing your trading environment and mental endurance is just as important as reading the charts. Trading requires intense focus, quick decision-making, and the resilience to bounce back from natural losing streaks without revenge trading. Setting clear daily profit targets and maximum loss limits prevents emotional burnouts and protects your account from catastrophic single-day drawdowns. Professional traders view losses simply as the cost of doing business, treat wins with humility, and focus strictly on executing their edge over hundreds of trades. When you view every market order as a business transaction governed by math and discipline, you unlock the consistency required to thrive in the world's most competitive financial markets. Transitioning from theoretical knowledge to real market execution requires a structured approach to position sizing and account management. One of the foundational rules enforced by U.S. financial regulators is the pattern day trader (PDT) rule, which applies to margin accounts with less than $25,000 in equity. Understanding these regulatory boundaries allows you to structure your trades properly, whether that means using a cash account to avoid PDT restrictions, focusing on swing trades, or funding your account to meet minimum thresholds. Proper position sizing is the mathematical shield that keeps you in the game. You must calculate your share size based on the distance to your stop loss, rather than picking arbitrary share counts. This ensures that every trade carries the exact same dollar risk, regardless of the stock's individual share price. To consistently extract profits from the market, you need to understand how to manage active positions once you are in the trade. Scaling in and scaling out of positions, taking partial profits as the stock reaches key target levels while moving your stop loss to break even, locks in gains while keeping you exposed to further upside. This technique reduces psychological stress, allowing you to ride large market trends without constantly worrying about sudden reversals. Furthermore, learning how to trade both sides of the market through short selling or put options enables you to profit during broader market corrections and bear markets, ensuring your trading business remains adaptable regardless of overall economic conditions. Ultimately, the journey to becoming a consistently profitable trader requires long-term commitment, continuous learning, and self-awareness. Financial markets evolve over time, and strategies that worked in high volatility environments may need adjustments during quiet consolidation phases. Surrounding yourself with disciplined trading communities, reviewing your performance metrics weekly, and remaining physically and mentally fit are essential components of long-term endurance. By prioritizing risk management over instant gratification, respecting market mechanics, and continually refining your personal edge, you set yourself up to achieve true financial independence through the discipline of modern trading. As you reach the advanced stages of your trading journey, the focus shifts from simply finding good setups to scaling your operations and managing complex portfolio dynamics. Long-term performance in the financial markets depends on how effectively you handle capital allocation across various market regimes. Diversifying your active strategies, such as combining high-frequency day trades with long-term trend following and income-generating option strategies, creates a balanced revenue stream that smooths out equity curve fluctuations. As your account size grows, executing orders efficiently without causing excessive slippage or market impact becomes vital. Utilizing advanced order types like limit orders, trailing stops, and bracket orders ensures that your execution remains sharp, precise, and automated even during moments of extreme volatility. Navigating the U.S. tax landscape and legal framework is another critical aspect that every professional trader must master. Understanding the difference between short-term capital gains taxes, mark-to-market accounting under Section 475F, and tax-advantaged trading accounts can save you thousands of dollars each year. Working with a qualified CPA who specializes in trader tax status allows you to deduct eligible business expenses, optimize loss carryforwards, and keep a significantly larger portion of your trading income. Treating your trading activities with complete legal and fiscal rigor turns your personal account into a legitimate, scalable business structure built for compounding wealth over decades. Mastering the stock market is an ongoing, lifelong journey defined by continuous adaptation, relentless self-discipline, and deep respect for risk. The financial markets will constantly test your emotional endurance, but sticking to your rules, honoring your risk boundaries, and prioritizing longevity will set you apart from the vast majority of retail participants. Remember that consistent profitability is not about hitting home runs on every trade. It is about stringing together small, calculated wins while keeping your losses strictly controlled. Stay patient, stay disciplined, trust your system, and let your edge play out over the long run.